Now onto Common Sense with Craig. Financial decisions you make now and before the end of the year can have a big impact on how much you pay Uncle Sam come April 15th. Craig Bolanos, the CEO and founder of Wealth Management Group, is here with tax tips. Hello, Craig.
That's right, Angela. It's all about saving on taxes, and here's some simple solutions that people really should consider. Number one, check your withholding. If you were hit with a big tax bill, it could simply be that you were under withheld, had the wrong number of allowances. So use a free tax estimator. Better yet, contact your trusted advisor and look to maybe update your W-4 before the year comes to a close. When you're investing, you should always be thinking about tax loss harvesting. The tax code allows you to sell investments that have dropped below your purchase price, and those losses can offset any realized gains. And to the extent that your losses are more than your realized gains, you can deduct up to $3,000 per year on your federal 1040. Third, be aware of phantom income. Before you invest any new monies in mutual funds between now and the end of the year, double check, triple check that those mutual funds aren't going to pay a capital gain distribution, because there'd be nothing worse than making an investment just before a capital gain distribution hits. You don't want to be picking up any phantom income. Next, your future retirement wants you to max out your 401k, contribute to an IRA, get a tax deduction today while at the same time you plan for the future. And a big part of retirement, a big part of today, is just managing unreimbursed healthcare expenses. So be sure that if you have access to a health savings account, the only triple tax preference vehicle on the planet, that you top off that HSA health savings account each year, because who wouldn't want to pay for unreimbursed medical expenses with tax deductible dollars?
What are some strategies for charitable deductions?
Well, Angela, what jumps out to my mind is under the new tax code, everybody in America can give $300 of cash to a charity and get a deduction regardless of whether or not they itemize on Schedule A. So that'd be $600 for a married couple, $300 for someone who's single. Take advantage of it and help those charities in need if you're in a financial position. Number two, maybe you want to be more assertive. You want to be bigger with your charitable deductions. I encourage everyone to look at a donor advised fund for those who are looking to accelerate charitable deductions into the current year, aka bunching deductions, looking to maybe avoid the capital gains tax on the sale of an asset, or you use a combination plan where you're making a large charitable deduction in the current year to offset the tax implications of a larger Roth IRA conversion. All of those give rise to the benefits of a donor advised fund. And lastly, when it comes to giving wisely, giving to charity, I think about the qualified charitable distribution. If you have retirement accounts, if you've attained the age of 72, then I'm talking to you. The first dollars you give to charity really should come directly from your IRA in what's called a qualified charitable distribution. That's being tax smart. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you want to learn more about tax saving strategies like this, you can. Go out to our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.